In the closing years of the 19th century, the United States possessed the factories, railroads, mines, and financial markets of an emerging world power. What it did not possess was an institution capable of protecting that system when confidence collapsed. There was no Federal Reserve, no permanent lender of last resort, no central authority able to move reserves toward failing banks, expand currency during a panic, or stop a local shock from spreading across the country. When the system broke, Washington had to search for someone powerful enough to do what the government itself could not. That absence was not an accident. It was the result of a political struggle that began with the founding of the Republic. For generations, Americans fought over a question that appeared technical but was in reality constitutional, economic, and deeply personal. Who should control the nation's money? The first battle began inside George Washington's cabinet. Alexander Hamilton, the first Secretary of the Treasury, inherited a country that had won independence but had not secured financial credibility. The Revolutionary War had left the federal government and the states burdened with debt. Veterans held promises of payment trading for a fraction of their face value. Foreign lenders remained uncertain whether the new republic could honor its obligations. Hamilton believed that weakness could destroy the country. He had studied Britain and understood that military power rested on something less visible: organized credit. The Bank of England helped the British government borrow, fund wars, and mobilize resources on a scale few rivals could match. Hamilton saw public credit not as a concession to bankers, but as a weapon of national survival. His solution was ambitious. The federal government would assume the debts of the states and establish a bank capable of holding government deposits, issuing notes, extending loans, and creating a reliable financial network. The plan would also bind creditors, merchants, and state governments to the federal government. A nation whose debts were managed collectively would become harder to divide. Thomas Jefferson reached the opposite conclusion. Jefferson believed the republic's strength rested not in financiers or commercial cities, but in independent landowners. He feared that a national bank would concentrate influence among speculators, merchants, and wealthy investors. Once financial power became centralized, political power would follow. He also argued that the Constitution gave Congress no explicit authority to create a bank. Allowing the government to claim such an implied power, he warned, would open the door to unlimited federal expansion. The disagreement was larger than banking. Hamilton imagined an industrial and commercial nation with strong federal institutions and access to international capital. Jefferson envisioned a decentralized republic whose citizens would remain protected from distant authority and concentrated wealth. In 1791, Hamilton won. Congress approved the first Bank of the United States, and Washington signed it into law. The bank received a 20-year charter and $10 million in capital, with the federal government owning 1/5 and private investors controlling the remainder. Its headquarters stood in Philadelphia, but its importance extended far beyond one city. The bank collected federal revenues, held government funds, issued notes, and provided loans. Its branches formed the beginnings of a national financial network. The institution largely did what Hamilton promised. Federal securities recovered in value. Government operations became more orderly. American credit improved abroad. A reliable currency helped connect regions that had previously operated through fragmented local systems. Yet success did not settle the argument. To the bank's opponents, it only demonstrated how much power had been placed inside a single institution. Foreign ownership intensified those suspicions. British investors held part of the privately owned stock, an uncomfortable fact in a nation that had only recently fought Britain for independence. When the charter approached expiration in 1811, Hamilton was dead, the Federalist Party was declining, and Jefferson's allies dominated the government. State-chartered banks had multiplied, and many resented a national competitor able to restrain their lending. The renewal failed in the Senate by a single vote. The first bank disappeared. Within a year, the United States was at war with Britain. The War of 1812 exposed the consequences. Without a national bank to coordinate borrowing and payments, the Treasury struggled to finance military operations. State banks issued notes aggressively, often without enough gold or silver to redeem them. The currency system fragmented, inflation rose, and federal credit deteriorated. By 1814, the government's financial position had become desperate. The crisis forced former opponents of Hamilton's bank to reconsider. James Madison had once resisted the institution on constitutional grounds. As president during wartime, he confronted a different reality. Ideological suspicion could not pay soldiers, supply armies, or restore the government's ability to borrow. In 1816, Madison approved the Second Bank of the United States. The new institution was larger than its predecessor, capitalized at $35 million, again with the federal government holding a 20% stake. It was expected to stabilize the currency, supervise state banks, and serve as the Treasury's fiscal agent. But it opened badly. Its first leadership allowed reckless expansion. Loans flowed toward insiders and political allies. Oversight was weak, speculation accelerated. Instead of disciplining the system, the bank became entangled in its excesses. Then the economy turned. The Panic of 1819 became the first major peacetime financial crisis in the nation's history. Agricultural prices fell. Land values collapsed. Speculators failed. Banks closed. To protect itself, the second bank tightened credit and demanded repayment, deepening the contraction it had helped create. The damage was severe in the South and West, where farmers and small borrowers faced foreclosure. To them, the bank did not appear to be a stabilizing public institution. It looked like a distant creditor using federal power to save itself. The crisis revived the oldest warning against central banking. An institution created to defend prosperity could become an instrument of privilege. By 1823, the bank was under new leadership. Nicholas Biddle was disciplined and unusually skilled in finance. Under his direction, the second bank recovered. Its branches monitored state institutions, its notes circulated widely, and its policies helped create a more uniform currency. Biddle understood that the bank's influence operated through pressure. State banks printed notes and promised to redeem them in gold or silver. The second bank could accumulate those notes and present them for redemption. If a state bank had issued too much paper, the demand for hard currency forced it to reduce lending. By deciding when to extend credit and when to withdraw it, Biddle could influence conditions across the country. It was an early form of central banking power, indirect, technical, and immense. To supporters, the system imposed order. To enemies, it gave one unelected institution authority over credit, prices, and survival. Andrew Jackson belonged firmly to the second group. Jackson's distrust of banks was rooted in politics and experience. Earlier financial losses had left him with a lasting hatred of paper money and speculative credit. He viewed the second bank as a privileged corporation protected by federal law, but controlled largely by private wealth. Its national reach made it more dangerous in his eyes. The bank could favor allies, punish opponents, influence elections, and direct capital toward one region while starving another. No institution with such power, Jackson believed, could remain separate from politics. The conflict became known as the Bank War. In 1832, supporters pushed an early renewal of the charter, expecting Jackson either to approve it or suffer politically for destroying a successful institution. He chose confrontation. Jackson vetoed the bill. His message transformed a dispute over administration into a struggle between ordinary citizens and entrenched wealth. He attacked the bank's privileges, questioned its constitutionality, condemned foreign investment in its stock, and argued that government had no right to make the rich richer through special legislation. Jackson placed the bank at the center of his re-election campaign and won decisively. He interpreted that victory as authorization to finish the institution. The charter still had several years to run, but Jackson refused to wait. In 1833, his administration began removing federal deposits and transferring them into selected state banks. Critics called them pet banks, accusing the administration of rewarding politically connected institutions. Biddle responded with the weapon available to him, credit. The bank reduced lending and called in loans. His apparent objective was to demonstrate how essential the institution had become. If businesses failed and markets seized, Congress might force Jackson to reverse course. Instead, the strategy confirmed the president's accusations. To much of the public, Biddle appeared willing to inflict economic pain to preserve his authority. The bank's defenders saw necessary discipline. Its enemies saw financial coercion. Jackson prevailed. The federal charter expired in 1836. Biddle continued the institution under a Pennsylvania charter, but the effort failed. By 1841, the bank had collapsed. The United States had eliminated its most powerful financial institution. It had not eliminated the need for one. What followed was called the free banking era, a name suggesting open competition and local independence. In practice, it produced extraordinary confusion. Banks were chartered under different state laws and issued their own notes. By the 1850s, thousands of varieties of paper money circulated. Their value depended on the reputation, location reserves, and survival of the issuing bank. A note might circulate at full value near its source, but trade at a discount hundreds of miles away. Merchants consulted publications listing banks. describing their notes, warning of counterfeits, and estimating what each piece of paper was worth. Every transaction required judgment. Was the note genuine? Did the bank still exist? Could it redeem the promise in specie? What discount compensated for the risk? The system rewarded deception. Some institutions were organized in remote areas, making redemption difficult. These wildcat banks could issue more paper than their reserves justified and disappear before note holders reached them. Not every bank was fraudulent, but there was no national authority capable of coordinating reserves or supplying liquidity when fear spread. That weakness mattered because banking rested on confidence. Banks kept only a portion of deposits in cash and loaned out the rest. Under normal conditions, the model functioned. During a panic, it could become fatal. If depositors rushed to withdraw at once, even a solvent bank could run out of currency. Its failure frightened customers elsewhere. Withdrawals weakened other banks, forced loans to be called, pushed businesses into bankruptcy, and converted financial fear into economic collapse. No institution stood above the system with the resources and authority to stop the chain reaction. The Civil War forced Congress to confront part of the disorder. The National Banking Acts of 1863 and 1864 created federally chartered banks and authorized a standardized national currency backed by United States government bonds. A heavy tax on state banknotes gradually drove many competing currencies from circulation. America finally gained something close to uniform paper money, but it still did not gain a central bank. The system could not adjust the currency supply easily when demand changed. National banknotes were connected to government bonds rather than the immediate needs of commerce. During harvest seasons, cash moved into agricultural regions, interest rates rose, and credit tightened. The structure became least flexible when pressure was greatest. The consequences arrived in waves. In 1873, the failure of J. Cook and Company, a major financier of railroad expansion, helped ignite a panic. The New York Stock Exchange closed for 10 days. Banks failed, unemployment spread, and the depression that followed lasted for years. 2 decades later, the Panic of 1893 produced another devastating contraction. Hundreds of banks suspended operations. Railroads entered receivership. Factories closed. Estimates placed unemployment in the high teens. Once again, the country faced a crisis without an institution capable of containing it. This time, the rescue would not come from Congress, the Treasury, or any public authority. It would come from a private banker whose influence had grown large enough to substitute for the missing machinery of the state. His name was John Pierpont Morgan, and by the time Washington turned to him, the question was no longer whether financial power would be concentrated. It was whether anyone could control the man who held it. By the 1890s, John Pierpont Morgan occupied a position no private citizen was supposed to hold. His influence extended through railroads, steel, electricity, insurance, and banking. He did not merely finance American industry. Through reorganizations, mergers, and interlocking boards of directors, his network helped determine which companies received capital, which executives retained control, and which competitors disappeared. When the Panic of 1893 threatened the United States Treasury, Morgan became more than a financier. He became an emergency institution. The crisis had weakened confidence in the government's commitment to the gold standard. Investors and foreign creditors exchanged paper currency for gold, draining the Treasury's reserves. If those reserves fell too far, the government risked losing credibility at home and abroad. Washington possessed no central bank capable of organizing a response. Morgan did. He assembled a syndicate of private bankers that supplied the Treasury with gold in exchange for government bonds. The arrangement prevented an immediate breakdown, but it came on terms favorable to the financiers who organized it. The rescue exposed an uncomfortable reality. The federal government of an industrial power had become dependent on a private banking network for financial survival. Morgan had not created the weakness. He had simply become powerful enough to exploit and temporarily repair it. The same pattern returned in 1907. The immediate spark was a failed attempt by speculators to corner the shares of United Copper Company. When the scheme collapsed, banks associated with those involved came under suspicion. Depositors began withdrawing money. Fear spread from conventional banks into New York's trust companies, institutions that performed many banking functions while operating with fewer restrictions and smaller reserves. The Knickerbocker Trust Company became the crisis's most visible casualty. Once depositors lined up to demand their funds, confidence vanished. The trust suspended operations and panic moved through the city. Credit froze. Businesses struggled to obtain cash. Financial institutions began hoarding reserves rather than lending them. The crisis spread beyond Wall Street into the broader economy. Again, there was no central authority prepared to intervene. The Treasury could release government funds, but it lacks the organization and reach to coordinate the entire banking system. Clearinghouses could support some institutions, but they could not guarantee that the panic would stop. Morgan stepped into the vacuum. From his library in Manhattan, he and his associates reviewed the accounts of endangered institutions. They decided which firms appeared solvent, which required assistance, and which should be abandoned. Bankers were pressured into contributing money to emergency pools. Rival institutions were compelled to cooperate because the failure of one could threaten them all. Morgan's methods were private, improvised, and authoritarian, yet they worked well enough to prevent the immediate collapse from becoming even worse. The rescue also demonstrated why the arrangement could not continue. Morgan was 70 years old. His authority depended on reputation, personal relationships, and the willingness of other financiers to obey him. There was no guarantee that another individual could repeat the performance during the next crisis. More disturbing was the power such a rescue required. Morgan and a small circle of bankers had effectively decided which institutions would survive. These decisions affected thousands of employees, depositors, investors, and businesses, yet they were made without public hearings, statutory rules, or democratic accountability. The absence of a central bank had not prevented centralized financial power. It had privatized it. Congressional investigators eventually turned their attention to what critics called the money trust. The Peugeot Committee, established in 1912, examined the relationships connecting major banks, corporations, and securities firms. Its investigation documented a dense system of interlocking directorships. Partners and associates of the leading financial houses occupied seats on the boards of companies whose combined value represented an extraordinary portion of American industry. The committee's findings intensified public suspicion that access to credit was controlled by a narrow financial elite. This was the historical contradiction Andrew Jackson had failed to resolve. Jackson destroyed the Second Bank of the United States because he believed concentrated financial power threatened liberty. But the decentralized system that followed did not distribute power evenly. Repeated instability allowed the strongest private institutions to grow larger, absorb competitors, and become indispensable. By the early 20th century, America faced two dangers at once. Its banking system was too fragmented to manage a national crisis, yet its financial leadership was concentrated among private firms powerful enough to influence the entire economy. A German-born banker named Paul Warburg believed he understood the solution. Warburg came from a banking family in Hamburg and had trained in several European financial centers before settling in the United States. Through his marriage and his position at Kuhn, Loeb and Company, he entered the upper ranks of New York finance. The American banking system astonished him. European central banks coordinated reserves and could provide liquidity when commercial banks came under pressure. The United States instead scattered its reserves among thousands of institutions. In calm periods, those reserves remained idle or were drawn toward New York. During emergencies, banks protected themselves by refusing credit precisely when the economy needed it most. The currency was also inelastic. Its supply could not easily expand during harvest seasons, financial panics, or sudden increases in commercial demand. To Warburg, the design was not merely inefficient, it was dangerous. He began publishing proposals for reform, arguing that the United States required a reserve system capable of coordinating the nation's banks. Such an institution would issue currency responsive to economic conditions and serve as a lender of last resort. But Warburg recognized the political obstacle. Americans remained deeply suspicious of the words central bank. The memories of Hamilton, Biddle, and Jackson still shaped political language. Any proposal resembling the Bank of England or appearing to hand greater authority to Wall Street would face immediate opposition. The reform, therefore, had to provide central coordination while appearing decentralized. The Panic of 1907 created the political opening. In 1908, Congress passed the Aldrich-Vreeland Act, authorizing temporary emergency currency and establishing the National Monetary Commission. The commission was tasked with studying foreign banking systems and recommending structural reform. Its chairman, Senator Nelson Aldrich of Rhode Island, was one of the most influential Republicans in Washington. After examining European central banks, Aldrich became convinced that the United States needed a comparable mechanism. He also understood that bankers could not openly write the proposal. In November 1910, Aldrich and a small group of financial experts traveled in secrecy to Jekyll Island, a private club off the coast of Georgia frequented by some of America's wealthiest families. The participants included Warburg, National City Bank President Frank Vanderlip, Morgan partner Henry P. Davison, Assistant Treasury Secretary A. Piatt Andrew, First National Bank President Charles D. Norton, and Aldrich's secretary Arthur Shelton. They traveled under the cover of a hunting expedition. According to later accounts, they avoided using surnames so that railroad staff would not identify the group. The secrecy reflected more than personal caution. If the public learned that representatives of the country's most powerful banks were privately drafting a new monetary system, the plan could be politically destroyed before it reached Congress. During their stay, the group developed a framework built around regional reserve institutions coordinated through a central governing structure. This design answered two competing needs. It pooled financial reserves and created a mechanism for emergency lending, while the regional structure avoided the appearance of a single dominant bank in New York or Washington. The proposal became known as the Aldrich Plan. Politically, it failed. Progressives condemned it as a Wall Street project. Democrats resisted legislation associated with Aldrich and the Republican establishment. William Jennings Bryan and other populists warned that private financiers were attempting to formalize their control over the nation's credit, yet the central ideas survived. After Woodrow Wilson won the presidency in 1912, banking reform returned under Democratic leadership. Representative Carter Glass and Senator Robert Owen guided new legislation through Congress. Wilson demanded a public Federal Reserve Board, appointed by the president to supervise the system. The resulting structure was neither fully public nor fully private. 12 regional Federal Reserve banks would serve different parts of the country. Member commercial banks would hold stock in those institutions. Above them, a federal board would provide national oversight. The arrangement reflected political compromise rather than theoretical purity. Bankers thought it allowed too much government interference. Populists believed it preserved too much private influence. Advocates of regional control feared domination by New York, while supporters of central authority worried the system would remain too divided. Its contradictions were also its political strength. Nearly every faction could claim it had prevented something worse. On December 23, 1913, Wilson signed the Federal Reserve Act. The United States finally possessed a permanent reserve system, an elastic currency, and an institution designed to supply emergency liquidity. But the law did not end the historic argument. It changed its terms. The question was no longer whether America needed centralized financial authority. Repeated panics had made that answer increasingly difficult to deny. The new question was who would control that authority. The Federal Reserve carried elements of every earlier struggle. Hamilton's belief in organized national credit survived in its central functions. Jefferson's fear of concentrated power survived in the system's critics. Jackson's distrust of privileged financial institutions remained embedded in public suspicion. Morgan's private rescues demonstrated the danger of leaving systemic power without public structure. The Fed reduced some vulnerabilities, but it did not make financial crises impossible. Its early policies became subjects of intense historical debate, especially regarding the credit expansion of the 1920s and the catastrophic collapse that followed. Nor did its creation produce a simple division between government and finance. The system was deliberately built at their intersection. That ambiguity has shaped its legitimacy ever since. The deeper lesson is that monetary systems do not emerge naturally. They are designed through conflict, negotiation, and crisis. Their rules determine where credit flows, how losses are distributed, and who receives protection when markets fail. For more than a century, Americans tried to escape the danger of concentrated financial power by refusing to build a lasting central institution. The result was not an economy without central authority. It was an economy in which central authority appeared during emergencies in the hands of whoever possessed enough money, influence, and confidence to command it. The Federal Reserve was created to replace that private improvisation with a permanent system. Whether it democratized financial power or merely reorganized it remains the question at the center of its history.